People can make a lot of money from investments, and they can also lose a lot of cash simultaneously. This is why we need to tread carefully. Intelligent investors have a lot to consider if they want to understand a company's long-term value, a business portfolio of investment opportunities, the competition it faces, and a detailed look at its financials are all parts of that process. Proper investors do not rush or speculate. They play a long game and have the appropriate analysis about any company before they invest. As said earlier, there is a lot of money to be made from investments, but not everyone is willing to be a proper investor. An intelligent investor knows that if there is a probable margin between what you pay as the investor and how the company grows, there is a potential to make sufficient profit. Not everyone succeeds from investments, but anyone that wants to invest the right way should focus on three main principles. The investor should properly observe the long-term gain from the company he/she intends to invest in. You have to thoroughly, if possible, overanalyze the development and business principle of the company you wish to invest in. The following principle is, a proper investor should never put all their eggs in one place. All intelligent investors never place all their bets on a single company. They diversify their resources and never spend it all in one place. Lastly, proper investors never expect rapid returns on their investments, but rather a steady growth on their returns. Every good investor has some level of knowledge about the stock market history. If you do not know how the past functioned, how can you survive in the present? The first thing to always do before you invest is understand how the past worked. In essence, know some history. Understanding stock market history is an intelligent investor's job. Historical data tells you what financial products did well in the past and better prepare you for future success. Having historical knowledge would also let you have a diverse portfolio, so even if there is a problem with the stock market at any time, you would not be significantly affected. It ensures you can take big hits and survive. You should also know about the history of the company you wish to invest in so that you can adequately assess well before you invest. Don't follow the crowd. Knowing what to do when a stock crashes or a bubble burst is vital to being a successful investor. Investors have been unable to predict the timing of market turns in advance, so it's impossible to time the market. Because market crashes and corrections happen over extended periods, investors should not be trying to predict when they will happen, but should know how to handle them when they inevitably occur. A good investor should not follow trends but rather stick to their portfolio. A stock generating profit now does not mean it would generate profit in the future. Sometimes as well, some investors deceive themselves because they see some gains in the now. They feel they notice a pattern and trick themselves into thinking a stock is profitable and when it's losing. When it comes to investment, do not trust the public or the stock market. Stick to your portfolio and be cautious.